Welcome to Module 3 of the Yield Curve Strategies reading in fixed income. In this module we're going to look at volatility strategies, that's yield curve volatility, and then we're going to look at applying key rate duration to profit from a view on a change in the shape of the yield curve. So first up we're going to think about yield curve volatility strategies. We should really think about what yield curve volatility is. Of course, we're talking about the volatility of yields. Really, we're talking about the volatility of changes in yields, okay, that delta Y that we've been talking about. So, in simple terms, a very volatile yield curve will have lots of big shifts up and down, all right, relative to a not so volatile yield curve, which won't have such big shifts up and down. That's the way to think about this volatility here. Now, of course, we know the key contract or asset, if you like, that has a value that's linked to volatility is an option. In fact, we know from our basic option theory that if volatility increases, then the value of all options increase. Whether they be calls or puts, we know that there's a direct relationship between options and volatility. The idea here is that volatility in yields flows through duration, essentially, into volatility in prices, and that volatility in prices will boost the value of options. So yes, I mean, when we think volatility is going to increase, we should be long options. When we think volatility is going to be low, then maybe we should sell options, or we should not take long option positions. Of course, there are some instruments with options embedded within them. We have met these before. A callable bond is a bond, well, it's a straight bond, an option-free bond, and a short call position, because the call is with the issuer. The issuer has the right to buy back the bond prior to maturity, and the borrower, the issuer, chooses to do that if rates fall. Now, it's this short call exposure that the investor has that gives a callable bond negative convexity at low yields. In other words, if we plot yield here versus price, for our option-free bond, we'll likely have a convex relationship like this, the kind of the convex smile. As yields go up, prices fall. As yields go down, prices rise. That's a straight bond. That's an option-free bond. A callable bond is likely to have a similar profile when yields are high, but as yields fall, you'll find that the bond will not go up as fast. The callable bond will not go up as fast. In fact, it will curve over here and will have negative convexity at low yields. Now, the reason for that negative convexity is obviously the short call option that's embedded in the bond. The call option here is becoming very valuable at low yields, but we're short it, so it's detracting from the value of our callable bond. And that leads to negative convexity at low yields. In other words, you see the smile turns into a frown at low yields here. That is essentially negative convexity. Another way to look at it, of course, is that if the bond is callable, if the call price or the strike is here, then the bond won't trade above the strike if it's callable within a reasonable time frame, because no one's going to pay, if the strike's 100, no one's going to pay 101 for something that's going to get called back at 100 in the near future. That's why the bond is curtailed in terms of its price rises. Now, we don't get negative convexity in any other situation. I mean, there is negative convexity for mortgage-backed securities, but of course that's related to the prepayment option, which is really the right of the borrower to pay back the loan early, which is the same as a call. So that's a similar scenario. We only get negative convexity on mortgage-backed securities or callable bonds at low yields. We don't get negative convexity for puttable bonds. You might remember from previous levels that a puttable bond is a straight bond, an option-free bond, and a long position in a put, the right to sell the bond back to the issuer prior to maturity. So the investor here has the option. They hold the option, which gives them value this time. If we look at if this were a straight bond, a puttable bond an equivalent puttable bond would look something like this, where it wouldn't go down so much. So a puttable bond has a floor underneath it, essentially. The implication is that the strike of the put is somewhere here. Nobody would sell the bond below the strike if the bond was imminently puttable. Instead, they would choose to put the bond back to the company. So it puts a bond price floor, it puts a floor on the bond price when yields are high. Notice there's no negative convexity there. So generally, when volatility increases, we want to be long options. So if volatility is increasing, puttable bonds will benefit. Callable bonds will suffer because the short call option will become more valuable, and that's bad news. However, this is just a vaguer comment, and it's far more likely that we're more interested in the risk sensitivities, the major risk exposures of fixed income, that being duration and convexity. So let's think a little bit about how adding options to our portfolio affects our duration and our convexity. Actually, let's go back to basics. When you buy a bond, if you go long a fixed coupon bond, let's remember that if you're long a fixed coupon bond, that means you've got positive duration and positive convexity. Okay, the price track is convex. There it is. We've drawn it many times. Okay, and neater than that, I'd say. But we've drawn it many times, that kind of convex smile. That will do. If we buy a bond there, as yields fall, the implication is yields are falling as we move to the left. It's the same axis here of yields versus, well, I'm going to make the, I'm going to view the y-axis as like profit from our starting point for this analysis. Profit is positive as we go up, and we go up faster due to positive convexity. Profit is negative. In other words, we have losses if yields rise, okay? And those losses, they decelerate, don't they? Those losses, they occur at a slower rate, don't they, for our long bond, due to positive convexity. Now, this means if we short a fixed coupon bond, we're going to get the opposite of this. We're going to get a negative duration. In other words, our profits are going to be directly related to rates instead of inversely related rates. Don't forget, positive duration means there's an inverse, essentially inverse value rate relationship. Yeah. And you can think, it means we win if rates go down, which you can see happening here. Rates go down, yields go down, we profit. This, of course, means we've got a direct value in our portfolio versus rates. So what does that mean? It means we win if rates go up. All right. I think that's okay. A negative duration is okay. We're kind of getting used to that, I think, at level 3. But here comes something to pay a bit of attention to and to be careful with. When you sell a bond, you get negative convexity. So just to picture what's going on here, you actually turn this profile over on its head. If we've got P&L here, profits, losses, as we go like down and up respectively. As you can see, the losses, when we sell a bond, the losses as yields fall, they accelerate. This is negative convexity, isn't it? Whereas the gains, they decelerate. We gain at a marginally decreasing rate as yields. Once again, the implication is yields at the horizontal axis. So negative convexity is, it's not a good thing. It's a frown, as we know, and it does mean, like, from a P&L perspective, the rate at which we win slows down, the rate at which we lose speeds up, which we don't really like. Think sort of negative gamma with options. Now, let's think about what our options or our derivatives are likely to behave like from a duration and convexity perspective. So a call is the right to buy. It's giving us a long exposure, a potential long exposure to a fixed coupon bond. So a call is going to be in this camp here. It's going to increase our duration. It's going to increase our convexity. Okay. A put is the right to sell our fixed coupon bond. So a long put has a negative duration, which I think most people are okay with. The right to sell a bond will become more valuable as bond prices fall. All right, so you win as bond prices fall, as rates rise. You win as rates rise, so that's a negative duration. I think most people will be comfortable with that. Just be careful with negative convexity for a long put. All right, a long put will win as prices fall. All right, now we've kind of flipped it here. We win as yields go up and prices fall, but as you can see, the rate at which we win decreases. So the put brings through this negative convexity simply because bond prices they don't fall as fast when yields get really high. So yields get really high, prices don't really budge. The put doesn't really go further into the money very much, and that means the payoff from the put doesn't change very much. So we're not getting much change in the payoff of the put. We're not getting much increase in value. That is negative convexity, where if you like, profits are slowing down as we move further into profits. That's coming through in the long put. Okay, what else have we got? Well, we've got futures. Hopefully, it's relatively intuitive that if you go long futures, you're just really saying you'll take a delivery of bonds later on. So it's like a geared position in a long bond. And short futures, hopefully it's intuitive. You're delivering bonds later, so you're not shorting them today, but you're going to short them later on. So that will bring with it negative duration and negative convexity. Now, the other type of option that I want to talk about here, and the slides will summarize all of this, but I want to take a big picture on it, is a swaption. Now, with a swaption, as we already know, because we've already spoken about them at length, you can have a receiver swaption, which is the right to enter into a receive fixed swap. All right. Or you can have a payer swaption, which is if you hold it, it's the right to enter into a payer swap. Now, where are we receiving fixed here? It's up here, isn't it? It's this position that is receiving fixed. In fact, we can put receive fixed swaps up here. They're going to have positive duration and positive convexity plus receiver swaptions. They are going to have positive duration and positive convexity. So why is that? Well, receive fixed instruments, they win when rates go down. Yeah, and because you're receiving, you've got the right to receive a series of cash flows. It's like you've got the right to buy a fixed income. It's like you've got the right to buy a bond. So we've got exactly the same fixed income exposures here as we have under a call, which we've already said we're comfortable with the fact it's positive duration and positive convexity. Okay. Now that means, of course, you can think that a pay fixed swap, which is the right to, the pay fixed swap is where you've got the obligation to pay away the fixed leg. That's like you essentially being short a bond, all right, and putting the proceeds on deposit at a floating rate. So a pay fixed swap has got negative duration. It's like being short a fixed coupon bond, all right, and it's got negative convexity. But also a payer swaption will follow this exposure as well. A payer swaption is the right to enter into a payer swap, the right to essentially establish a short fixed coupon bond position, and very much like a long put. And on that basis, we've already established with care, we trod carefully and said a long put has got a negative duration and negative convexity, and a payer swaption will bring the same exposure because it's essentially like the right to enter into a short fixed coupon bond position and a long floating bond position. Okay, so this is a crucial vista. I try to kind of get my drone out here and fly up and look down at the big picture, and hopefully that's helped. The slides step through this and agree with us, fortunately, with what we just saw when we sent up our drone. Okay, with regards to a call option, we said the right to buy will have a positive duration. The right to buy a bond will have a positive duration. Hopefully, just to reinforce, we said that as rates fall, prices will rise, and therefore calls with their fixed strike will rise in value. So what have we got? we've got an inverse rates call relationship, and yeah, that's a positive duration. All right. It'll also increase the convexity as well, and that is because when rates go your way, if rates fall, prices rise at an increasing rate. So the call will reflect that. That will pay off at an increasing rate. Yeah. Now the trickier one is the put option. Remember, with the put option, if you're long a put, you actually have lower duration. I think most people are comfortable with that. You know, if rates go down here, prices rise. But actually, as far as puts are concerned, that's not a good thing. The right to sell something that's worth more at a fixed strike is actually going to fall as prices rise. There's an inverse price-put relationship, isn't there? So yes, we've got an inverse of an inverse here, but it leaves us back with a direct relationship between rates and our derivatives position, and that is a negative duration. Remember, a positive duration is an inverse relationship. Now, we did say that puts, being long puts, decreases your convexity. And that is true. A long put position has negative convexity because you're essentially selling bonds through a long put. The way to realize this is to think, well, imagine if our put started winning. That would be when rates go up and prices fall. All right, that's when our put starts winning. That's when, if we think about our long bond setup, we're so familiar with, that's when rates and yields go up and prices fall. But they fall at a slowing rate, don't they? So we win at a slowing rate. The put, you know, when rates go up, prices will fall, and the put, yeah, the put will win. But, you know, rates go up, if you like, a lot in order to get a little bit of gain. We've got a marginally decreasing rate of decline here, haven't we? It's decelerating, if you like. And unfortunately, when yields fall and the prices go against us, it's accelerating. So that's when we flip this over and realise we've got negative convexity when we, you know, when we sell bonds or we're long a put on the bond. Another way to think about this, actually, and the slides are coming out from a slightly different angle, which might be more easily to see. I don't have to draw this because I've already drawn it. Do you remember we drew a puttable bond here? That puttable bond, which is an option-free bond plus a put, it's pretty much a straight line when we get in the money here. In fact, that is a straight line there. A straight line's got zero convexity. All right, so that, you know, convexity is zero there. Once the put's deeply in the money. The option-free bond has still got some convexity. It's not massive, but it's still got some. And you can see, therefore, that adding the put to go from the red line to the purple line decreases the convexity of the payoff. So yes, the put does lower convexity of the portfolio. Okay, the next slide we kind of spoiled a little bit as well off slide with when we sent our drone up to take a 10,000 foot view. We said that a pay a swaption, we viewed it like that's the right to pay fixed, isn't it? So that's the right to sell a bond, a fixed coupon bond. Yeah, it's like the right to sell a fixed coupon bond or short it and put the proceeds you know, in the floating rate markets or buy an FRN. That's what we've got the right to do. So it's all about the fixed coupon. That's driving our duration and convexity. We've got the right to sell a fixed coupon bond. So we know that's going to leave us with negative duration, yeah, and negative convexity, because when we sell bonds, we get negative convexity. When we sell fixed coupon bonds, we get negative convexity. With a negative duration, we know that rates, you know, we've got a direct relationship with rates, so we know we win if rates rise. That's what the slide's telling us here. What I would say, though, is, you know, just to really, if you like, triple lock our understanding, you could always go back to your basic swaps diagrams. If you pay a swaption is the right to pay fixed. If you pay fixed and you receive in floating, you're going to win. Even if it's the right to do that, you're going to win when that floating rate goes up and you choose to do it. So you win if rates rise, therefore you've got negative duration. You could have got there that way. They don't mention convexity on the slide, but I think the curriculum does mention this negative convexity when we're dealing with paying away the fixed leg also. By the way, you can view a swap's duration like we do in derivatives as the duration of what you're receiving, which is the floating side, which is going to be small, minus the duration of what you're paying, which is the fixed side, which is going to be big. You don't forget, floating rate assets have a small duration, usually estimated as half a coupon period, because the bond resets at the next coupon period, resets to market rates at the next coupon period. So cash flows aren't fixed for long. Of course, a fixed coupon bond, by definition, it's got quite a high duration because all of its cash flows are fixed. So this is going to be negative. Same logic. Receiver swaption is the right to receive fixed, and the right to receive fixed is similar to buying. The right to buy a fixed coupon bond, and and sell the FRN essentially to fund it. And if you're buying the fixed coupon bond, that brings on positive duration. All right, you win if rates fall here. Okay. And by the way, that brings on board positive convexity as well. Okay, so let's move away from talking about volatility strategies. Let's revisit key rate duration and think about an example in the curriculum where we use key rate duration to analyze the performance, the active return of a portfolio versus a benchmark given a non-parallel change in the yield curve. So we know already that key rate duration, also called partial duration, all right, is your sensitivity to a move in a key maturity whilst other rates remain constant. So I always like to think of if you're in a recording studio, they've got those big mixing desks with those sliders. What you're doing with your yield curve here is you're not pushing all the sliders up and down across all channels. You are just pushing one channel up and down and seeing what the impact on the portfolio is. So when we think about yields versus maturities, what you're doing here is you're saying, okay, let's push up the 5-year yield up here, but leave everything else the same. Everything else stays the same. And if the portfolio falls by, that's a 5-year maturity. If the portfolio falls by 1% when I shift the 5-year yield up and nothing else, then I've got a 5-year key rate duration of 1. Okay, and in simple terms, where you've got high positive key rate duration, that's where you've got cash flows, and you must be expecting rates to fall at those maturities. All right, it's obviously not a good thing if rates go up and values fall. All right. So this allows us to interrogate what happens if there's a non-parallel shift. By the way, the sum of key rate durations is really telling you the impact on the portfolio of all maturities shifting up, and of course that is rates at all maturities shifting up. That's a parallel shift, so that tells you your effective duration or your modified duration. Right? Same thing for an option-free portfolio. So if you've got negative key rate duration, that means you must be expecting those rates to rise. Just like if you took negative duration overall in a portfolio, you're expecting rates to rise. That's the active play, as we've already said. Now, I think the graphic is really just repeating what we've already discussed. We're just changing one key rate at a certain key maturity, and our changing value of the whole portfolio. It's important to realize it's the changing value of the whole portfolio is going to be our key rate duration multiplied by how much that key rate shifts by. Okay. We can now think about, where our portfolio has key rate exposures. Obviously, a bullet would have exposure in the middle. A barbell would have exposure in the ends. And we can think about what the expected performance would be given a non-parallel shift in the yield curve. Incidentally, partial duration, key rate duration, and even duration contribution when we think about modified duration contribution or effective duration contribution, the sensitivity measure, they're all the same thing. As we're about, these names mean the same thing. Duration contribution is the weight that you have in a certain cash flow multiplied by its modified duration. Okay, as you'll see, that actually is your key rate duration. By definition, that's your portfolio sensitivity to a move in that a move in that rate. All right, the impact on that cash flow going through the portfolio's weight. That is your key rate duration, which is also called your partial duration. Hopefully that'll become clearer when we do an example. And here is an example. We've got 3 3 maturities here. These are all zero coupon bonds. To simplify the analysis, they've only got one cash flow at maturity. 2-year bonds got an annualized yield of 2, 10-year bond 3, and so on. You can read the table. The manager's portfolio position is quite punchy in that we've got long 2-year names, long the 20-year name, but we're actually short the 10-year name. By the way, if you add up those values, we get the overall portfolio value, from which we can deduce portfolio weights. That all adds up to 300, which you can kind of see. Notice that the benchmark is equally weighted across the zero coupon bonds. All right. So what are the questions here? Firstly, calculate the key rate duration and overall modified durations for the manager and benchmark. So yeah, key rate durations really should be based on modified duration. Modified duration, we go through Macaulay duration, which is really easy for zero coupon bonds. Average time is maturity for zero coupon bonds. And we modify those Macaulay durations by dividing through by 1 plus the periodic yield. Incidentally, these annualized yields, we're going to assume that they're annualized yields on an annual pay basis. And what that means is they are the effective annual rate of return of the bond. We're assuming, I know there's no coupon here, but we're assuming annual periods when we're quoting, if you like, annual compounding when we're quoting these annual yields. So we don't need to take these yields, for example, and divide by 2 because it's a semi-annual convention. We're assuming an annual pay basis convention. In other words, those annualized yields are the effective annual yield that the bond is earning. It's not a flat quote of a semi-annual yield doubled or a quarterly yield multiplied by 4, which is how bonds with non-annual coupons would be quoted. So what we're going to do is we're going to modify durations by dividing through by 1 plus the periodic rate of return of the bond, which would be just those quoted annual yields. In fact, that's the first thing that happens here. The modified, obviously Macaulay durations are always just the maturity for zero coupon bonds because there's only one cash flow at maturity. So the average time, don't forget Macaulay duration is average time. The average time of the cash flows is maturity because there's only one cash flow that happens there. That's the simplification from using zero coupon bonds. To get modified duration, which as we know is your actual percentage sensitivity in terms of price for a 1% change in rates, all right. What we're going to do is modify Macaulay's duration. We do that by dividing through by 1 plus the periodic return of the bond. Now this is why I made it clear that we're assuming that periods are annual here, because we're going to just divide through therefore by 1 plus the yield of the bond, the annual yield of the bond. If the bond had been semi-annual, you'd have to divide all these rates by 2 and then divide by 1 plus that periodic rate of return. Okay. However, what we've got here is an average. What we've got is an average time of 2 for the 2-year bond, 10 for the 10-year bond, 20 for the 20-year bond, and we're dividing through by 1 plus the yield each time. And that's how we get these modified durations. Now, these modified durations are really telling you what the sensitivity of the individual cash flow is to a unit move in that rate. Of course, the portfolio hasn't got 100% in any of these cash flows. The weight of the portfolio in these cash flows is 250 out of 300 in the first one, in the 2-year one, all right, minus 50 out of 300 in the 10-year one, and 100 out of 300 in the 20-year one. So these are the weights, and we're multiplying these modified durations of the cash flows by their weights. These are actually duration contributions. Your contribution to duration is weight times modified duration. And also that's going to be, by definition, your key rate duration as well, because it's your portfolio's sensitivity to a unit move in rates, because you're scaling the cash flow sensitivity, this modified duration, down by the portfolio's allocation to that cash flow. Think about it like this, if the 2-year rate moves, the cash flow will move by 1.961%, but your portfolio's only got 250 out of 300 in that cash flow, so your portfolio is going to move by less, 1.634. It's pretty big weight, isn't it? But it's going to move by less. Okay, so hopefully you can follow how these come through. These are the modified durations Well, these are the key rate durations, all right, which is really the weighted modified durations at each maturity. Sum them up and you'll get the total portfolio duration, total portfolio modified duration, 6.365. Now, the question was, calculate the key rate durations. We've done that. And the overall modified durations for both the manager and the benchmark. Oh, okay, so we've got to do this for the benchmark now. Okay, so remember the benchmark is equally weighted, 1/3 in each. So you can proxy it as 100 out of 300, but it's just 1/3 in each. That's the weight in each one. You've got the same modified durations for the individual cash flows. It's just the weights that are different. All right. And you come through here with a total portfolio duration of 10.239 and different key rate durations at each maturity. So the important thing here is the manager's active view. The active view is the difference between the portfolio's key rate durations and the benchmark's key rate durations. In other words, it's this one here minus this one here, which equals this, and so on. And what we see, so this is the manager's active view. Now don't forget, we take a positive duration, in this case a key rate duration, when we expect rates to fall. Okay, it's the inverse rates price relationship. Okay, so what do we expect here? We've got positive duration there, so rates to fall maybe. We've got zero duration here, so maybe we're neutral on rates here. We've got negative, massive negative duration here. If our duration is less than zero, that means we expect rates to rise, because having a negative duration means essentially we've got a direct relationship between our profits and rates, and obviously as rates rise we'll win. So we must expect rates to go up quite a bit here given the sensitivity that we've taken, now the negative duration that we've taken at the 10-year level. Now if we try and picture what's going on here, oh by the way, we've got a negative duration overall, so we must expect rates to rise overall. All right. So in terms of the play here, what have we got? We've got short-term rates are, falling, all right, because of that positive duration there, and not as much as 20-year rates. So if you think about it, short-term rates are falling, but not as much as the 20-year rates. That's a steepener, okay? We do expect, intermediate rates to rise as well. So we have got this increase in curvature. All right, we've got a steepening, haven't we? Particularly at the short end here, that's a steepening, and an increase in curvature. All right, and we've got a negative butterfly. You might remember that a negative butterfly is shift. This is where we frown more. All right, where we get sadder. It's an increase in. It's where we become more negative. We frown more. It's an increase in curvature. Okay. So these are the views that the manager has. Overall, they think rates are going up, so they're a bear. All right. Because short rates are falling and long rates are not falling as much, you can argue there's a steepening. All right. Short rates are falling, long rates are not falling as much. Okay, there's a steepening going on. Intermediate rates are rising, at least that's their view. All right, and that means there's an increase in curvature as well, so a negative butterfly. We're going to frown more. That concludes Module 3 for the yield curve strategies reading in fixed income.